Tesla stock was struggling in the later part of the trading day to stay green. You did close in the green, up 0.17%, up marginally in after hours. We actually got some pretty big news that dropped in the last hour or so of the trading day. Apple is no longer pursuing an Apple car. Elon Musk said on January 14, 2021, prototypes are easy, volume production is hard, positive cash flow is excruciating. For a company like Apple that tried to make an EV for 10 years, that has a cash pile of $162 billion and still ultimately came to the conclusion that it's too hard and that margins would be too small, even at a $100,000 price. That's kind of insane, because if there was any company that could develop a good car and be successful doing so, that's not a Rivian or a Tesla, and Rivian's fate is still very much undecided, I would think it would have been Apple, and I would think it would have been pretty successful at that. This ultimately means Tesla is going to have a lot less longer-term competition now that Apple's no longer in the EV quote-unquote race. Ford and GM, they're really scaling back investments. Stellantis also scaling back investments. Toyota really hasn't even started investing into EVs. I mean, Tesla is the clear winner. Tesla has always been the clear winner, but again, if there was anyone that could create a product that has a strong brand loyalty already, it would have been Apple. I mean, let's be honest. I couldn't think of a better company besides Tesla to get into the car market than Apple. Originally, Apple wanted it to be a fully autonomous vehicle, but they didn't have the vehicle fleet, real-world data, nor the experience to be able to accomplish that. There are only two American car companies that haven't ever gone bankrupt. That is Tesla and Ford. And I think Apple came to the ultimate conclusion it was going to cost way too much to get this car into mass production. And Apple doesn't really manufacture anything itself. It's kind of like Nvidia. It outsources pretty much all of its labor. Apple instead says they're going to focus on generative AI, whatever that specifically means. And Apple stock went up 1% in after hours, and that did bring up the broader markets. S&P 500 up about 0.25%, including the slight green move as well here in after hours. It looks like Apple wants to get in on the AI FOMO. But keep in mind, coming on March 12th, we're going to have some serious downside catalyst for the overall AI trade. That is because SoftBank owns 80% of ARM stock. Now, SoftBank is in a bit of a sticky situation, if you will, because their ARM position is worth more than the entire business of SoftBank. Now, SoftBank tried to sell ARM for $30 billion before, $40 billion before. They've tried to sell the stock, their position, their stake, many, many times, and they have failed to do so, whether it is antitrust concerns with Nvidia or just back in the day they were unsuccessful in selling ARM. They acquired ARM back in 2016. Now, SoftBank hasn't really made the best investment decisions. They lost $14 billion on WeWork, that company that just went bankrupt a couple of months ago. The entire market cap of SoftBank is around $85 billion, and their ARM position is worth over $100 billion. They are able to sell as many shares as they want coming on March 12th, and I think the markets will start to price that in beforehand. So maybe by the end of this week, maybe that's a little bit of what you've seen today. ARM was down 5.64% today. I've been very vocal on this. ARM is likely going to fall a lot more from here. I don't know how low we're going to go, but I do think this could put a damper on the entire AI trade as of right now. Now, coming on March 12th, you'll also get CPI that comes out the same day. So I think the question really is, does SoftBank sell a majority of their stake? Do they dump on the markets, or do they sell 10% or 20%? But there's no question, they're definitely going to sell stock. I bring that up because that's important to remember as a backdrop to everything else that is going on in our markets. We know that is likely to be a negative catalyst coming in March. Markets will price that in ahead of time, so probably next week, but it looks like it's even starting now. You could see more downside in the overall AI trade. Now, some people are like, why would SoftBank selling ARM affect the other AI stocks out there? And it's pretty simple. It's all algorithmic based. This whole market is algorithms, right? Less than 5%, 10% of the trading volume on a any day basis is actual humans or investment managers. It's all quants, it's all algorithms. So when one stock like ARM falls, and maybe falls a lot, it will cause selling in NVIDIA and SMCI and other names. Given the AI trade is the only logical thing that is keeping stocks up right now because of the value creation it is added to all of your big tech names, if that AI trade does start to give way in the next week or two, that could be a bit of a problem for broad markets, for Tesla, for other stocks as well. To my prior point, just to show you how algorithmically based this market is, this is kind of insane. Sven Hendrick says, quote, on X, this market is trading like rates are at zero and QE is running through the system. He says, no, it's not. During zero rates and QE, there was some occasional volatility, corrective activity, and at least the pretense of two-way price discovery. This here is something else, and that just summarizes it perfectly. During the best of times, you used to get corrective activity, you used to get price discovery, you'd go up and down, kind of volatility back and forth. Like this period of time back here in 2021, stocks would move, volatilely, right? And now they just don't. Now they basically go up in a straight line. And take a look at the volume as well. And this is actually the RSI as well. Basically correlates with volume also. I mean, there's just zero volatility right now. Zero volatility at all. It's kind of insane how green things have been. This is all algorithmic trading. This is pretty obvious. Now, coming tomorrow morning, we will get some very important data, but in case you missed the last video, in case you slept in today and took the day off, well, we had durable goods orders month over month come in at negative 6.1%. Last month was revised from 0% to negative 0.3%. This is by far the worst 2 months of durable goods orders numbers that we have seen in a long time, in like the last couple of years, at least dating back to mid 2022 as per, actually, let's see. This is the worst durable goods orders that we have seen since the Rona drop, the artificial Rona drop. Beyond that, you have to go back to the end of 2019, and that's the last time everyone thought we were heading into recession. And this durable goods orders drop, I mean, is worse than that. So you have to go back to what? 2018? 2018, the start of 2018, to get a drop this big in durable goods orders. What happened and what did stocks do? Well, my friend, stocks just went to the moon again today. Continuing on their trek, and looks to make another all-time high if the data comes in as the bulls hope for tomorrow. But again, I just want to remind you, when durable goods orders just plummet like that, that's usually not a good sign. It's usually not something to be excited about if you are an investor. This, my friends, is the time to be raising cash and getting ready to buy the dip when the dip does come. And trust me, the dip will come. Tomorrow morning, we're going to get GDP growth rate, quarter over quarter, second estimate for Q4. Now, last month, the estimate was 4.9%. This is a revision. So we're expecting this number will get revised from 4.9% to 3.3%. That's a pretty big downward revision. If you only get revised down to like 4.5%, markets may fall on that. Because of the narrative, if the economy continues to do well, the Fed's not going to be able to cut rates. And just kind of like what we've seen today, durable goods orders came in way worse than expected. Russell stocks outperformed. If durable goods would have came in good, then you probably would have seen a sell-off across the board. Same, I think, is true for the GDP numbers tomorrow morning. If GDP, let's say, only gets revised down to 4.5%, or maybe even goes higher, maybe it goes to 5%, who knows, then I'm sure you'd probably get a sell-off in the markets at that point. If you come in at like 2% GDP, then I would say small caps probably continue to outperform. The S&P and the NASDAQ have pretty muted days overall. But let's not forget the fundamentals of the economy and investing. You want to see good economic activity. So you want to see this number as high as possible tomorrow, because your worst nightmare for an investor, especially if you're a leveraged investor, if you're full bull right now, is to get really bad GDP. Sure, really bad GDP would definitely cause stocks to rally in the short term. But if you go into that recession, yeah, you are not in a good place. And GDP, this is the second estimate for Q4 GDP. So we'll see. There's typically 3 revisions. The second one tends to be the largest because you get the first number the first time, then you get revised the second time. The third revision, the numbers tend to be pretty accurate around the second revision. So that's going to be very important coming tomorrow morning. Now, you will get real consumer spending, quarter-over-quarter, second estimate, a lot of revised data in regards to the GDP numbers. Goods trades balance, retail inventories, excluding autos. You will also get at 8:30 in the morning, wholesale inventories month over month. Data for January, expecting that to fall to 0.2%. Don't think that's a huge deal. You've been negative for a long time, so to go positive, really not a big deal there. And then at noon tomorrow, you will get Fed Bostic that will speak. At 12:15 p.m., you will get Fed Collins that will speak. And 12:45 p.m., you will get Fed Williams that will be speaking. Now, your big data of this week is going to be coming out on Thursday, so don't think it's over just tomorrow. Thursday, you're going to get your core PCE month over month. Expectations are really high there, so maybe there's a chance you come in a little bit lighter than expected and stocks do okay, but 0.4% month over month for core PCE, I mean, that's insane, right? Times that number by 12, and that's your annualized run rate. You're looking at 4.8% GDP on a 12-month annualized basis is 0.4% month over month. The Fed's not going to be cutting rates if that's the number that we do get, and that could put a big halt on this market rally that we have been seeing. You're also going to get personal income and personal spending on Thursday, but I'll break down my expectations a little bit more coming tomorrow in the video that comes out at the same time, around 8:30 p.m. But I will tell you, tomorrow morning, I'm expecting quite a move based on the GDP, especially if we do get a big revision, which that's kind of what we've seen lately is big revisions. Now, in regards to Tesla, I just want to remind you guys that there's a lot of call options at that $200 strike. So the market makers, they want to keep Tesla under 200. So don't be surprised that Tesla will rally in, the beginning parts of the day and then sell off towards the end of the day. It's because the market makers want the stock under $200 per share. That's the bottom line here. If you do run above 200, if you really start to get some momentum, if the data goes in the right direction for small caps, for a stock like Tesla this week, you could see a big run. If the market makers have to start buying stock, they have to start buying millions of shares of Tesla. Considering today's volume was 108 million shares or so, just if Tesla stock goes to about 210, market makers are going to have to buy about potentially 12 million or more shares of Tesla And those numbers are getting larger by the day as more people are going out and they are buying these options. Now you have 30,000 for open interest at the 210 call, 12,000 at the 207.50 call, 25,000 for open interest at the 205 call, 10,000 for open interest on the 202.50 call, and 61,000 for open interest at the $200 call. So yeah, I'm expecting we're either going to stay under $200 per share this week, or if we go above 200 by the end of the week, you're going to see a huge run in Tesla stock. But again, it really comes down to the data tomorrow, more specifically the PCE number that we get on Thursday. Big money is definitely bullish in Tesla, if not neutral at the bare minimum. You have seen over the past couple of days some pretty good option activity numbers. Now, today's a little more neutral than you have seen in other days. You had 950 orders totaling $314 million with a positive order value of 51%. If you look at the total call volume, about 64% of option activity was calls today, bullish leaning positions, and about 36.18% of the volume was puts. So about a 2-to-1 ratio, about 2 times as many calls compared to puts that were bought today in Tesla stock. That's a pretty good sign, but again, you got to get above that $200 call wall by the end of this week. That is, of course, if you want to see Tesla stock rally from here. We will have some earnings tomorrow morning with Baidu, Novavax, Advanced Auto Parts, and TJX. If you guys want to come trade some of these earnings with us, check out that link down below in the description of this video. The next couple of days, tomorrow and after hours, Thursday and Friday, you're going to have quite a few notable names here. Tomorrow and after hours, Marathon Digital. I did make a trade on that one as well. Snowflake, Salesforce, AMC, C3 AI, Paramount, Okta, IONQ, and Duolingo. I do plan to make some trades around Snowflake and C3 AI. Maybe Okta and maybe IONQ. We'll have to see. There's quite a few different things that I like to look at in judging whether or not it looks good for a potential trade. Thursday, lots of earnings there as well. Celsius, Best Buy, Chronos, Polestar, AB InBev, Bath & Body Works, Six Flags. Thursday after hours, Zscaler, SoundHound, Fisker, Dell, Autodesk, Hewlett Packard, and Viva. And then Friday pre-market, Plug Power, and Fubo TV. Something else that I have warned about here on the channel many times is right now, markets are priced for perfection. Markets are priced for no recession, and some areas of the markets are priced for a lot of Fed rate cuts. We went from pricing in 7 cuts to pricing in 3 cuts, and you have seen no change in the S&P 500 or the NASDAQ, basically zero volatility in the S&P and the NASDAQ, and you've priced out 1% of rate cuts in 2024 just in the last, 8 weeks or so. It's surprising how little volatility you have seen given that fact. Now, the consensus view is that we're going to get a soft landing. This also happened in the year 2000 and 2007, and yeah, those times did not end well. Now, the number of news stories with the term soft landing is definitely at a recent all-time high here, which is interesting because, 07, 08, the Fed had also been raising rates for multiple years. They had been on pause for about 18 months before they started cutting rates when the great financial crisis came, and everyone thought there was going to be a soft landing at that moment in time as well, and that's why stocks did well heading into the great financial crisis and then not so much after. I don't think we're going to have a great financial crisis situation, but I'm here to tell you it could take years before we do see, some kind of recession-like event. And markets can do well until they don't anymore. From now until an actual recession does come some point down the line, you got to remember where you are and where expectations are. If expectations basically everyone has for no recession, a soft landing, if you start to get data like we got today with durable goods orders that shows we may head into a recession, you can see dramatic repricing in equity markets. And I think you guys will relate quite a bit to this one. It seems like everyone is out there chasing the markets. Not necessarily just retail investors. I think retail is a little bit more cautious than hedge funds, money managers, investment banks. Take a look at this note out from Barclays today. They say, quote, the U.S. economy continues to defy rate headwinds in 2024, much as megacap tech continues to defy even the most bullish earnings targets, raising our S&P 500 price target to 5,300 from 4,800. Quote, U.S. exceptionalism extends into the new year, but yet we just had the worst durable goods orders number, as I showed you on that chart, the steepest decline since 2018. I mean, that's not a great trend, and I don't think that shows the U.S. economy is defying the rate headwinds. We'll see with GDP coming tomorrow. You could see a big, negative revision. Who knows? But yeah, it definitely feels like even banks are chasing this rally that we have seen in markets. Now, why do I say this? It's not to be a bear or the bearer of bad news or put doubt onto this rally necessarily, but the way that I like to invest, the way that I have found makes me money, is not chasing when everyone else is chasing, whether it's to the downside or to the upside. If everyone's super bearish, that's the time where I like to take the contrary trade. I don't know when the flip will happen, right? When everyone's bearish, I don't know when stocks will bottom to the day or the week. Finding a bottom, a little bit easier than finding a top, because stocks can only go to zero, and ultimately valuations become more of a tailwind as stocks fall. But that's the point. When everyone is so one directioned, I like to take the other side of that trade. And I think there are some obvious data headwinds coming up. I do think the ARM lockup on March 12th, the next CPI report on March 12th, the next Fed meeting could also be quite a, bit of a problem for markets out there. Overall, I think people are way too happy and jolly about the state of the economy, about inflation, and where we're going next. I don't know when we fall, but it sure seems like over the next couple of weeks, we could be in for a little bit of a problem. After all, let's just be honest, markets have been straight up to the right ever since November, with literally no correction in sight. You've rallied over 24% in the S&P 500 just in the last couple of months. We are overdue for some kind of pullback. I really don't think this is crazy information. Nonetheless, let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.